Today I'm just dropping a quick video to show you part of a longer series I'm making about the efficient market hypothesis and Brownian motion and how the market's neither efficient nor Gaussian or normally distributed. And I'm basically going against the grain of orthodox finance theory. It's going to be quite a long video, but I'm just dropping little parts of it. Now, this isn't directly related to what many technical traders would say, oh, great, he's going to support us. But technical trading is one of the reasons to show how the market's not efficient, and that doesn't mean that technical trading is real. Now, here I've just got this is just simply a Gaussian random normal example of a randomly generated stock price. It looks quite real. It's quite typical. There's the prices. And what I've got is just simple moving averages, like the dark color is the 20-day moving average and the light color is the 5-day moving average. Now, that's quite common for technical traders. I won't go into the theory too much here. I've forgotten it. I looked at all that stuff well over 20, 30 years ago, maybe even longer, and quickly dismissed it because I was a trained statistician, economist who did business finance. I was an accountant, and also I studied a bit of philosophy, so it just didn't appeal. Funny enough, in philosophy, when we did logic, one of the jokes we did was stock markets predicted by hemlines, women's dresses, as well as some other ridiculous things. So the stock market's pretty notorious for being stupid. But anyway, I'll just run this thing a couple of times to show you how it's not really predictable. It flips on its head all the ideas. But people adjust and rationalise. That's the problem. Freudian rationalisation is a real problem when it comes to the stock market. And also people don't track their profits. They see they make a big profit one time, but they forget how much they've lost in the past. Or even if they do, they don't realise they're only just making a buy and hold return after all that transactions and waste of time. Now, I'm not an advocate of buy and hold. But if you have no better information, there's no point in going for technicals over that. And I'll just run it. And as you can see, the 20-day is moving up. The 5-day always mirrors the return because it's almost like a naive forecast. A naive forecast means that the last price is the best forecast for the future price. Now, with the 5-day moving average, it's pretty close to the last forecast. If you did 1, 2, and 3 days, because there is a small amount of auto-regression in prices. They do lag a few days and follow. This forecast was not so bad. It's showing it going up. It didn't really go up. It leveled out. So it's not, although that would imply that it is going to go up and up and up. But it's not too bad for one of those moving average things. You can see that once again, it's showing it's going down. There is a turn there. It is showing that it's turning, so it actually didn't do too bad there. It did go up. Here it didn't do any good at all. It just followed like an average would. But it's going nowhere. And the prices went really, on average, down, but nowhere. At that point, I forgot to mention the colours. See, this is the initial forecast, and it breaks there to show from there, where do you think it's going to go? And then it generates where it actually did go. From there and that moving average chart, do you think you could have picked it going there? I don't think anyone would have. I'll run it a few more times just to give examples. Now, it's showing going down on the quick one because the quick one is just merely naive forecast, really. However, the longer 20-day is going up. There might have been the famous crossover, but I mean, you may have got that, but you certainly wouldn't have got this rapid jolt up again. It's not a very successful method of forecasting, but if you're going to be a day trader, I suppose it's as good as any. It may be marginally better than guessing, marginally at best. But in my future video, I'll go into it in more depth and explain why it's not a good way to, about 20 to 40% of people make money on any good year on the stock market, and actually 50 to 60% actually lose. It's not a zero-sum game. There's not equal amount of winners and losers. It's a curious thing. And in general, most people only get the return on the index at best. That's why the whole capital asset pricing model is described, and they say buy and hold index funds. That is an assumption that you cannot do better than the market. I don't believe that the efficient market hypothesis is true, and I hope to prove it. It's not true. People have beaten it, and it doesn't take a lot of skill. It just takes a bit of mathematical knowledge and a bit of carefulness. But technical trading's not it. I don't know whether I'll bother looking at other methods like Bollinger Bands and stochastics and things. I was going to, but you're never going to convince people that they don't work. You can see here the old moving averages have been wild all over the shop, and they predict nothing this time. Like that one's going up and that one's going down, and it just slowly went down. So yeah, if you relied on moving averages there, you would have been done like a dog's dinner. Anyway, I'll stop the video now. This is just a quick teaser for an upcoming longer discussion over more topics, and it'll be much more involved. Thanks. I hope you enjoyed. Bye.